Everyone. Hey, everyone. It's me, Kevin, here. Wow! I don't know why I did that. I just felt like doing it. Welcome back to Strongman Personal Finance. I'm sitting here in my garage, half naked, trying to think about a video to do. And I said, you know what? Let's review Shopify. Or as Lefebvre does, Shopify. So Shopify is a pretty popular stock. Why? Because it went up a lot in the last couple of years, and then it went down a lot too. And because one of the greatest investors of all time, who buys stocks that go down 95% or go bankrupt, and then he gets rewarded with Patreon and ad revenue, Jeremy Lefebvre. So we're going to do some research into Shopify stock, and I'm going to give you my honest opinion. And let me tell you what, I smelled poo-poo. Let's go, baby. Let's dive in. I didn't share my screen before I started this video. What a terrible YouTuber I am. Okay, so here's Shopify stock, right? Now, during the pandemic, okay, it went down a little bit. And then starting in March 2020, this stock had a massive run up. It went from $34.61 all the way to almost $170 per share. That's some pretty insane returns. And when stocks go up a lot, retail gets interested. Why? Because the stock went up a lot. That's all that matters. You buy the stock, it goes up. You're a genius. You buy it again, you become bullish on it. You make a YouTube video about it. It's the future, bro. It's only going to go up. Everybody else reinforces you, and they just shower you with money and attention. That's how it works, okay? And then Shopify absolutely collapsed. And all these retail clowns were like, oh, why did this happen? Why? It actually went lower than it was during the bear market, the very brief bear market of 2020. It's barely gone up, okay? And you have to ask yourself, why did this happen? Now I come on here and I say it's pretty common sense, okay, why the stock crashed massively. Do I know where the bottom is? No, I don't. Do I know where it's going to go in the next couple of years? No, I have no idea. But I can look at the financials and say, yeah, it kind of makes sense why this stock absolutely got freaking annihilated. So let's go look at another concerning feature before we even get into the financials. Cathie Wood, the genius, the clowness, Cathie Wood swoops in to buy Shopify stock after recent slump. If Cathie Wood is buying a stock, I can guarantee you, one, it's highly speculative. Two, the only good thing is revenue my avenue. And three, it's losing money hand over fist. I can 100% guarantee it. I mean, maybe she has one profitable stock that she bought, but I can tell you, Shopify is going to be unprofitable I've done almost no research, okay? I'm giving you my straight up impressions. Now, recently, the stock's gone, let's see. Oh, it's up 7%. It's down 10%, and we see a massive collapse. Why? Probably because of earnings and probably because of guidance. Let's go look at the most recent earnings, okay? Or not the most recent, recent earnings. Let's go look at the financial statements. And I'm going to give you my honest thoughts about this whole thing. First off, we see for the 3 months ended December 31st, 2022, they had revenue of $1.7 billion. That's a lot of money, right? And it's pretty insane growth year over year. So in December 31st, 2021, they had 1.3. So year over year revenue growth is almost 26%. That's pretty impressive revenue growth. Now let's see how much cost of revenue has grown, because the cost of revenue is very important for your profitability, of course. So cost of revenue has grown by 36%. Their revenue grew by 26%. Their cost of revenues, the cost of the subscription solutions and the merchant solutions, went up by 36%. Their expenses so far have grown faster than their revenues. Okay, let's see operating expenses. How fast have operating expenses grown? 987 divided by 678. Operating expenses have grown by 45%. So on the top line, the first margin that they have, that margin has gone down. Their cost of revenue has grown faster than their revenues, and their operating expenses have grown even faster than their revenues. Let me guess. Their losses are getting worse. Let's see what's causing some of the increase, okay? So a huge increase in their cost of revenues is from merchant solutions by percentage, okay? Subscription solutions, that cost of revenue went up by, let's do 85771 divided by 7, 13%, whereas merchant solutions went up by 39%. So they're having some cost problems in their merchant solutions, okay? And then we go look at their operating expenses. Sales and marketing, not really up that much. R&D, massive increase. Massive. Not quite a double, but a massive increase, okay? General and admin has more than doubled. And transaction and loan losses, okay, not very material increase in that, okay? But overall, they got massive increases in R&D that they're spending, and they have a lot of overhead, general administrative, that's increasing massively, okay? Their loss from operations, $188 million. That's right, they're losing money. And if you look at it from a yearly basis, $822 million loss from operations. You compare that to the prior year, they had a profit from operations in that last quarter, and they had a profit from the full year. So it seems to me like they're only profitable during a very specific special clown time, okay? And now they're going back to losing freaking money. And their costs are growing faster than their revenues. How wonderful. Okay? And then we have other expense and income. We need to go see what that is. Income loss before taxes, 614. And net loss, okay, $623 million this last quarter on 1.7 of revenue. That's a lot, okay? We take 623 divided by 1734. Oops. 1734. And we get negative 36% loss. Wow, that's great. Just explode your expenses, bro. Okay. And of course, we see share counts going up, so they're diluting you on top of that. Let's go look at their balance sheet. All right, cash went down. Marketable securities went down. Receivables went up. Cash advances, merchant cash advances, loans, receivables went up. And other current. So overall, their current assets went down by about $2.5 billion. Not necessarily a bad thing if it went to, I don't know, pay off high interest debt or maybe buy long-term assets. I don't know what they did. Okay. Let's see their long-term assets. Property and equipment went up. So they bought some property, plant, equipment. Okay. Right of use assets. That's leases. They have to record leases on their balance sheet. Intangible assets. They bought a lot of intangible assets, patents, trademarks, whatever they bought. Deferred tax assets went down a little bit. So they recovered some of the tax benefit, it looks like. And here I see something very interesting. Extremely, insanely interesting. I see equity and other investments went down by $2 billion. $2 billion. That's what's hurting their income statement, by the way. Is this freaking right? I can tell you right now, it's this write down from equity and other investments. What did they buy that they had to write down $2 billion? What did these clowns invest in where they got absolutely annihilated? I wonder, okay? When a company buys investments and they get schwacked like this, down 50%, they're gambling clowns. They're taking your money as the investor and they're buying a bunch of garbage that they didn't have to write down by 50%. $2 billion down on these investments. Wow. And then we see the goodwill account go up. Okay. So it looks like almost, what percentage of their total assets So roughly 18% of their total assets are goodwill, intangible assets, okay? And a huge portion of their assets are investments that they've already had massive write-downs on. These people are, whoever's like, what are they buying? I don't know. This is clownish, okay? Let's look at debts. So current liabilities, I mean, a lot of it's deferred revenue, accounts payable, that's normal. So they have total current liabilities of $856 million and total current assets of $6 billion. Okay, they're not going bankrupt anytime soon. Okay, they're doing okay when it comes to current liquidity. Long-term debts, let's see, deferred revenue, okay, whatever. Lease liabilities, okay, you have to put that on your balance sheet. Convertible senior notes, not much debt. And they had a massive decrease in deferred tax liabilities. So you'll see these deferred tax liabilities and deferred tax assets. These result from differences between GAAP accounting, what's on here, and what's on their tax forms. That's what happens. Sometimes you have differences, and sometimes you get a deduction on your books that is greater than your deduction on your taxes. That's going to reverse at some point. That's a deferred tax asset, and then vice versa, deferred tax liability. So overall, they're in a very good position. Now, where do I suspect most of this cash and marketable securities came from? I wonder. But the money that this company has received, they've put it into clownish investments, massively clownish investments. And they made a very large acquisition recently, and they paid $1.5 billion more than the fair value of the net assets of the company that they acquired, okay? Not always a bad thing, but if they bought a company that's also losing money, I don't know what's going to happen to that goodwill, but it might go down, okay? Let's look at their total shareholders' equity. So why did their equity go up? Okay, well, it went down. Why did it go down? Well, what helped equity, what boosted equity a little bit? Common stock issuance, okay? Massive issuance of common stock. Additional paid-in capital went down. That's interesting. Not sure why. I'd have to look more into that. Accumulated other comprehensive loss. That went up. It's probably currency. And then we have accumulated deficit. So they had such a massive loss by writing down whatever those investments were, that they now have a net total loss accumulated since inception, okay? So overall, their shareholder equity was destroyed by approximately $3 billion in the course of a year. And that masks how bad it actually is, because they had some increases in equity through common stock issuance, also known as dilution, okay? What a freaking, this company's trash. Okay, it just loses money, and they make clownish investments. You got to ask yourself, why did the management buy a company or buy a bunch of equity investments? They invested in other companies that they had to massively write down. They probably bought a bunch of clown stocks, just like Palantir did, okay? And now they made this huge acquisition. I don't know what that's all about, but we'll see how that goes, okay? Now, let's look at the reconciliation between net income and cash from operations. And Joseph Carlson, you need to take notes here, okay? You need to take note. You need to pay attention to what's about to be said. On the statement of cash flows, you're reconciling net income, which is the accrual basis of accounting, to cash flows, which is cash basis, okay? There are differences between accrual and cash. Non-cash expenses are added back on the statement of cash flows, Joseph. Non-cash gains, write-ups, are subtracted. That's how it works, and it's done under operating activities. So let's see what some of their non-cash expenses were. Well, we got amortization and depreciation. Oh, I guess according to Joseph Carlson, that should be under the investing activities. Sorry. Stock-based compensation. Oh, it's a conspiracy. Why are they adding it back here? That's distorting free cash flow. Stock-based compensation. $500 million. $500 million more of stock-based compensation. Dilution solution. And you know what that means, right? When the stock price goes up, if there's a rally, you're just going to get diluted even more. The higher the stock price goes, the more those options are eventually going to be exercised. So it's like you can't win, okay? Stock-based compensation, pretty significant increase year over year. Amortization, impairment, so they had to write down some leasehold improvements and whatchamacallit, leases. Let's see. So they're subtracting some things here, okay? So if you're subtracting stuff on the statement of cash flows, that was some kind of non-cash benefit that helped your income statement, but didn't provide you the business cash. That's why it's subtracted, okay? Revenue related to non-cash consideration, subtracted. Net loss gain on other investments, $3 billion. They had a $3 billion loss on one of their clownish investments they made. Oh, Joseph, should that go under investing activities? Should it? Because it says investments, bro. Okay. And some foreign currency. So overall, they had negative cash flows from operations over the last year. So they're losing money. They're buying clownish investments. They're investing. They acquired another company and paid more than $1.5 billion over the fair value of the net assets. Do you trust these people investing? They already lost half of their original investment or more with that all those other clownish investments that they made. And now they're acquiring another company. Let's see their cash flows from investing, okay? They bought some marketable securities. They sold some. Looks like they originated some loans. They repaid some loans, purchased some equity. They bought more investments. They bought PP&E, and they acquired a business, okay? They spent $1.7 billion of cash to acquire that business where you see that massive bump up in goodwill, okay? So what is the fair value of that business? What is it worth, like $200 million? Whatever. And then we have some, look at this, Joseph. Hey, Joseph Carlos, you see this? Cash flows from financing activities, net cash provided or proceeds from the exercise of stock options. Oh, it actually does show up in the financing part of the statement of cash flows. Okay. This company's a joke. It's a clown show. Negative cash flows from operations. Massive dilution via stock-based compensation. They buy clownish investments, and they just bought another clownish investment. What is there to like? They have a solid balance sheet. It's solid. They got a lot of cash and marketable securities. So they're not going bankrupt imminently, at least in my opinion. But do you trust the management when they make such stupid investment decisions that they have to write down half the value of the investments, the equity investments they bought? No, I don't trust them. Not at all. All right, we'll do some comments. Let's see. Sup, weak man. Bought my first. I can't say that word. It'll get me in trouble. How the F is Jeremy not in jail and his channel is growing again? Welcome to Clown World, baby. You lose 95% of your investment in Tattooed Chef. Doesn't matter. Here's more money. Holy Shokas. Shopify my Flopify. I like it. Jeremy will release a video exposing Strongman and his fake CPA license next week. Stay woke. I hope he does. OMG, I agree with Strongman on this one stock. Made analysis videos on Shopify before. Basically, if it's massively unprofitable and they make stupid investments, which they did, you can see the write-downs. Hell, you know I'm not going to like it. You know it. Come on, Sasha. Don't worry. I'll make a Tesla video. I'll put you on there. I'll even put a clown nose on you, okay? That makes you feel better. If more people were woke, wouldn't be so many brokey. Let's see. I love Strongman, but we defer in crypto. 2022 bear market, 2023 recovering, and bulligan. I'm going to give him some crap. So my crypto is up 4x and 10x already. You get 10x and then, you negative 100% and you're at zero. You know that, right? It doesn't matter if you 10x with crypto. There's no intrinsic fundamental value to crypto. It'll shoot up 20,000x, but if it drops 100%, it's zero. I don't care how many 10x's you've had. Kid Freshie eats purchases Oscar Mayer ham slices because they're simple. What is grinding my gears? Shopify is grinding my gears. It's pissing me off. You know, I don't even prepare for I really don't prepare. I just I pull up the financials, I skim them real quick. And then I just all right, let's go look. And I just kind of look at it and I'm like, oh, wow, I didn't know that they had to write down half their investment and they acquired another company. It's not hard to learn, really. That guy is insane. Who, me? You talking to me, boy? Woo! AMC still a thing? Why? Is it really? Is it really a thing? Let's see. But Shop only has a PE of 335. PE doesn't matter, bro. Just buy Shopify. I made more money from betting on a Russian ping pong match than buying. Well, you can basically do anything and make more money than investing in Tattooed Chef. When will it be a good time to buy stocks? Thank you for everything that you do, Strongman. Well, when it comes to index funds, if you have a long enough time horizon, whenever. Dollar cost average, man. That's all that matters. Let's see. Strongman buys VT whenever he can. I'm going to make a video about this to clarify this, okay? I bought Shop back in 2016. I'm so far up, even with the downfall, it doesn't really bother me. I still see a 10-year growth. All right, okay, you got it in a really low price, okay? But trust me, a lot of people bought it much higher than you did. Let's see. VT is a Vanguard ETF for the most of the entire global stock. That's right. All right, that's my thoughts on Shopify. It's another clown stock out there. I don't know what to say anymore. There's just clown stocks everywhere. All right, guys, that's it. Maybe I'll do a video on DCA versus lump sum because I want to clarify. How this works. Wait, what? That's not possible. Capital Mindset's in the house. I'm also in the financial industry. I hope one day we can debate. Okay, dude, there's so many clowns in the financial industry. If somebody says I'm in the financial industry, it doesn't mean anything to me. It means absolutely. You know, I used to be in the financial industry. Okay, I was a financial advisor. That means nothing. Absolutely nothing. And there's even plenty of CFAs out there that are massive clowns. Okay. I was investing in Shopify back then. There was a stock split. Oh. Shop the Amazon killer. Yeah. Okay. All right, everybody. Cheers.